Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Covered Calls and Short Puts, and today is a big topic. As a matter of fact, the topic that I've selected for today is really important to some traders, and as a matter of and along those lines, I actually even had someone leave a comment on a recent video that I posted where they were so annoyed that I didn't address this specific topic. They said, "Can't wait for AI to come along and replace you." That's how important it is. Now I gotta admire that sort of enthusiasm for a subject, but it's something that'll definitely catch my attention. I thought that's a really good topic. So what is the topic? Well, as we look at options right now, a trader might note, boy, those premiums seem extra juicy today. Why are the premiums so high? And it relates to volatility. So today we're going to have a discussion about the impact of volatility on options pricing and why juicy premiums may actually equate to higher risk when selling options for income. So it's an important discussion. Before we can get to the details of that, let me first of all say hello to everybody who's chatting in already. Lots of familiar names out there, a few that are new to me, but hello there. Eva, Tony, Cecil, Dragon Rider, Lawrence, Scott, Mark, Jack, everybody. Ravindra, great to see everybody. If you're one of our returning veterans, welcome back. I always appreciate your attendance, your contributions to these discussions. If you happen to be here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, watching those recordings is a great way to watch these webcasts. But if you'd like to be here in our live stream audience, this is a Monday webcast series. We kick things off promptly at 2 Eastern time. Now, I also want to let our live stream audience members know that my very good friend Barb Armstrong is hanging out in the chats already. She's keeping an eye on any questions that come in. And if I can't get to those, she's going to pick up slack for me. Thanks for having my back there, Barb. Barb and I would like to issue an invitation also for everybody listening to follow us on social media. So you can follow us on X. You can find Barb there. Give her a follow at Barb Armstrong CS. You can find and follow me on X at Cameron May CS. And as of a few months ago, you can also follow me on LinkedIn at linkedin.com/in and then /Cameron May CS. But let's get into this discussion. Big topic, the impact of volatility on income. But of course, income strategies, along with so many others, carry risk. So bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set an agenda for today's discussion. Yes, we're going to be talking about volatility and the pricing of options premiums. Before we get to that, though, we're first of all going to take a look at what's going on with existing positions in our example paperMoney portfolio. See if there's anything that needs to be done with those. We'll do a quick revisit of their track record up to this point. Then we'll look at the market conditions, see what's going on with stocks, see what's going on with options pricing, and then get to the business of planning and placing a new options trade, but being careful to review volatility and its impact on those options. So this is going to be a fun one. Let's go right to the thinkorswim desktop platform. So this is the simulated trading environment. In other words, this is the paperMoney platform. And I want to start off, here are our, let me scroll up here a little bit so you can see this. This is our covered calls and short puts group on thinkorswim. We have 4 positions: Apple, AbbVie, Amazon, and NVIDIA. So we'll start with Apple. With Apple, we own 100 shares. We've sold most recently the 20th of March 280 call. And I say most recently because that's important to keep in mind, because if we just look at these 4 positions overall, you might note, oh, they're not doing so well. Down $1,200. Well, there is a history to these positions, and actually we're up $3,800, not down. Right now we're down $1,200 on the current positions, but if we attach the history of these positions, there's more to be reported there. So Apple's a good example. So here's Apple. Right now we own the shares, and we've sold a 20th of March 280 call. That's this red text. But there's also some pink. This is our history. So this current position actually was preceded by the sale of 2 puts. Those just expired for $2.77 profit per share on 200 shares. That's about $550 of realized profit there. Sold at 16th of January 265 put for 270. That's another $270 of realized gain, but that one was assigned. So we purchased the shares at 265, sold a subsequent call at 275. That expired for a gain. And then we sold this call for 252, and we'll see how this one goes. But this position was taken last time we met, which was on the 23rd right here. Stock rallied up toward our strike, has pulled back away from that strike, and overall, I think that short call is actually doing very well as well. But right now, if we take into consideration all of the realized profits and you throw in this dividend of 26 cents that's been theoretically collected in this fake account, that brings our break even for this trade down to 251.78. So, Mark, you like that? The way that we've been playing out this Apple position? Very good. Very good. We'll see if it continues to cooperate. Right now, let's say that our investor is trying to make a decision. Well, do we keep the position? If we look at that Apple trade, the stock is right near break even. And this is very much, as a matter of fact, spoiler alert, as we go look at market conditions for stocks overall, Apple is representative of what so many investors and traders have encountered with just stock positions. And that is a little bit of up, a little bit of down, not a lot of anything. Obviously there can certainly be exceptions to that rule. But this is basically a break-even stock trade. It's the options, it's the income that's been doing all the work for us, right, Mark? Yeah. So that's an important discussion, especially in this webcast series, which is all about income. So let's make a decision. Stock position, do we need to unload that right now? Well, maybe our investor might note that it hasn't done a lot since the contract was assigned. We're basically right at that break-even point for the stock, but maybe they also note that we're right along an upward sloping trend line. Maybe things look like we're more likely to press upward and onward rather than break down and reverse course. Time will tell. But what we're going to do here is hold on to that. We're not going to close out, I don't think. Let's have another look at that call position. Sold that for 252. We might be able to exit for about half that cost right now. So maybe about 50% of the reward potential in that Apple call has been, it's an unrealized profit at this point. I'm gonna let that one continue to work. Let's move on to our AbbVie position, where we bought 200 shares, and we've most recently sold 2 calls for the 20th of March 240 strike. Those calls are actually a little bit underwater. The shares are a little bit above break even. We're up about $1,300 on 200 shares. That's okay. It's a few dollars. But here's what's going on with AbbVie. Here's the complete history of this position. Bought 200 shares, sold some calls, those expired for a profit. Sold some more calls, those expired for a profit. And very recently we've sold the, did I say the 2nd of March? It should be the 20th of March. Let me just adjust these. I think I just botched this up a little bit. We sold 2 March 20th calls. That's okay. I just don't have the strike price in there. So let's do that. Let me edit this. So it was 20th of March, 240 calls. Now the line can tell us that it was 240 calls as well. I just draw in these lines to help us keep an eye on where our strikes are. There we go. Helps a little bit to have more explicit language there as well. Dan says, I'm new here. What is your profit closeout or percentage goal? Looks like you're a Kansas State fan. All right. But with some, it's a good question. For some options traders, they will have an objective in mind for how much profit they'll be satisfied with before they close out a contract, or how much risk. And we talk about that kind of more explicitly sometimes when I have more time to dedicate to that topic. But a common approach, it's not everybody, certainly not. But let's say we sell for a premium. We recognize that premiums collected carry limited reward potential. So maybe in the spirit of attempting to optimize that as much as possible, maybe we don't exit unless we can get out and retain, let's say, at least 80% of the original reward potential of that option. That's one example. It's not by any means the way everybody does it. Okay, but what we'll typically do is, and if you're here for the very first time, what you should know is I don't do any trading in this webcast series outside of live webcast time. So all trade decisions are made on camera. So that can maybe help with weighing the pros and the cons of getting into these positions, weighing the pros and cons of the management of the positions, and weighing the pros and cons of exiting, for better or for worse. Okay. So, oh, by the way, so this one, our break-even is down here at 2204, including $1.73 dividend. We had 200 shares, so we actually collected about $356 in dividends right there. So that's lowered our break-even point down here. Obviously, we're well above that. I'm going to let this one continue to work. Still pretty far below our strike of 240. And if we look at the individual position here, 227 is what we paid for the stock. It's at 233, so that's profitable. 165 versus 292 to try to buy that call back, that would be unprofitable. We'll see if time can get us on the correct side of that part of the trade. Okay. Laura, you like that approach? You like seeing it all on screen? Great. Yep, I do that very deliberately. Let's have a look at Amazon. So Amazon, we own 100 shares, purchased at 235. This one is just brutalizing the portfolio. Terrible, right? Yep, this was an assigned contract. We'll look at that. And we've sold a call against that. That call's pretty much at break even. But let's go see the full history of our Amazon position. So Amazon, yep, this one was rough. Look at this. How bad could the timing get on this? Let's see, 235. Actually, this was just one of our strikes that we sold, so that's not terrible timing. Where was our entry, our contract was assigned? Anyway, we started off by selling some puts. Those just expired, and we realized a gain of about $740 there. Oh, no, sorry. Sold some puts for $740, but we closed out one of those for a 303 profit, closed out the second one for a 365 profit. Then we sold the 2nd of February 235 puts. These were the ones that were assigned, and that's why we have the 235 cost basis on the entry of the shares. We did collect $5.60 on those contracts, but that was it. This contract was actually assigned, and we had a note here to consider selling covered calls if assigned. Now the assignment kind of happened when, the stock had fallen because I believe I was out of the office for this decision. In any case, fell down below. We had a discussion to maybe sell the remaining shares. We've exited half of this position, sell remaining shares if this support breaks. It didn't break. We've been rallying since then. So I think what we'll do with this, we have how much total realized gain on this? Amazon. So the realized gain was, I did a calculation before the webcast, $1,788. That helps. That helps against the $2,600. Doesn't make this entirely profitable though, but it has been the income that's helped to soften the blow of a stock that completely misbehaved. But if this starts to misbehave again, we'll exit down here. It's not below that level, so we're going to hang on to that. Okay, so let's get on with our final position, which is our NVIDIA trade. We own 100 shares, and this one's going to lead into this discussion that I wanted to have today about the pricing of options, because, and you're going to see this pretty quickly, we got a big fat juicy premium last time, and I wanted to talk about why we got that. In any case, we bought 100 shares of NVIDIA for $183.71. It's just a little bit below break even, $1 below break even, but again, representative of what so many stock traders and investors are experiencing with today's market conditions. But we sold a call last time, I believe it was. If I click on the quantity here, it'll tell us, yeah, so this was last week. Sold a call for $8.50, got $850 on a strike that we've previously sold for way less. And that that call is only worth about $2.83 right now. So we might be able to exit. And what is that, about 65, 70%? I'd have to do more precise math to be more certain there. But most of the potential of that call has I can't say realized, but it's been accomplished. It's not realized unless and until the trader chooses to exit and is able to exit. All right, but here's the history of NVIDIA. So we bought 100 shares at 183.71. Look at this. We bought those right here. Look where we are right now. You can see that's basically a break-even stock trade, but the income, we have a little tiny dividend that was paid, so that hardly played any role at all. But we sold some calls, closed those out for a profit. Sold, I should say, sold a call, closed that for a profit. Sold another call, that one expired for 340 profit. Sold another call for a 193 profit ultimately. Sold another call for a 375 profit ultimately. But here's what I wanted to note. Look at this. We got 343, 340, 375, and one of these times we got 193. I think this was just a shorter term position, or we were just further away out of the money. Not sure. I'd have to look at that again. But in any case, comparatively modest premiums that were collected compared to the one that we got last week. We sold at the same strike. It's only a month till expiration. This red line shows us the length of our trade out here to our March 20th expiration. $8.50 collected. Why was the premium so high? If you were here, you already know the answer. There are certainly things that influence the value of options. Yes, selling closer to at the money is one way. Selling more time is another way that the premium can be increased, but also the volatility of the underlying stock plays a big role. And there are times when stocks are expected to be more volatile than at other times, very commonly. Not always. But last time, let's see, that was the 23rd. That was right. It was actually this little doji candle right there. So, oh, look at this. So number one, we were pretty close to at the money. That's going to dial up the size of the premium because we're not giving ourselves as much wiggle room to the upside before someone can come in and buy the shares from us at that price. So that's one trade-off. When we're seeing a juicy premium, it might be just because we've given ourselves no wiggle room to the upside on the stock. Another way that the premium might be juicier is if we go further out in time. This one, we didn't really go out any further than we typically do. The previous one was probably closer to a 3.5 week contract. That was this 375 contract that we sold. But time plays a role. Proximity to the current price plays a role, but also volatility. And at the moment we entered this trade, there was an earnings announcement it was the next day. I was going to say 2 days away. When the earnings are announced, we know that can really introduce some volatility to the stock price. And when there's greater expectation of volatility, typically premiums go up. I have to say typically because, well, actually, if there's an increased expectation of volatility, yes, options prices do go up. It's actually built into the pricing model. But I have to qualify that by saying that just because there's an earnings announcement very nearby doesn't necessarily mean that there's an increase at that moment of expectations of volatility. Sometimes traders and investors just think, well, this stock never delivers surprises. That earnings might not be a big deal. But in this case, yep, we got a big premium. Now, there's a way that we can track how expectations of volatility rise and fall. And that can have an influence on, it does have an influence on the expectations of the premium to be collected. And that is using this tool right up here. And this is this is the tool that the commenter who left a comment for me on a different video said, Cameron, your information is incomplete, and I hope AI replaces you so we can get better information. Well, I try to cover as much as I can in every webcast, And I definitely appreciate the enthusiasm for a point, but I thought that's a good discussion for next week. So here we go. Let's get into this flask icon, and I'm going to load up the Implied Volatility tool. Now, how many of you make a regular practice of checking the implied volatility? It doesn't have to be done. But let's load that up on our chart. If you're not familiar with this, I'm going to apply this to the chart. Let's just quickly cover what this tells us. What we're left with when we add this indicator to our chart is we get this green line. And for some, they just look at this as a general gauge of whether premiums are relatively high or relatively low on this stock at a given point. So if you look at where this green line is right now, the number over here may not be as important as just where the green line is relative to itself over time. Mark says implied volatility is one of my default studies on all my chart. Ravindra says not much, don't check it very often. Dan, almost every time. Well, what is this telling us? If our implied volatility is right here, let's get our line tool. Maybe we'll even use the price level, even though this isn't a price. I can click on that volatility and just kind of pull this back into history, and let's see where that positions us. Well, what the trader might note here is that volatility has been a little bit higher here, a little bit higher here, but overall, since June of last year, this is relatively high volatility, implied volatility, compared to where it's been most of the time over the last year. So what does that tell us? Well, implied volatility is a great term for what the indicator is. It's the expected volatility among options traders for the underlying stock over the next 30 days. So if options traders are expecting greater volatility, you'll see this line climbing. If options traders are expecting lower volatility, you'll see this line falling. And what does that matter about the pricing of options? Well, as expectations for volatility increase, premiums will increase because there will be typically greater demand from options traders for those options. The speculators see that volatility as potential to move the stock to deliver profits on their options positions. Hedgers might also increase the demand for options on that stock as they see volatility as a risk that they might be trying to mitigate with the options. So it can increase demand from speculators, increase demand from hedgers, increase the premium overall. So that's what we're seeing here as this fluctuates up and down. It's an expectation of future volatility reflected in the pricing of options. I hope that makes sense. Laura says, I hope you put little weight on rude comments. No, I totally get, yep, that's the way the internet works. And I also understand the sentiment or the motivation of most people. I don't think they give it a whole lot of thought when they leave a comment, when they're enthusiastic about a topic and they disagree, or they see, an issue with the presentation that's been delivered. I get it. They probably didn't spend any more emotional energy than to leave a comment and to move on to somebody that they find more value from their webcasts. Yep. So that's okay. It's fine with me. It actually led to what I think is an important discussion to the point they were trying to make. Anyway, so what we might conclude by looking at the implied volatility on NVIDIA is that options premium is still fairly high. But at the moment we sold these contracts last week, they were even higher. And if we compare that to when we were selling contracts back here, yeah, we were actually getting lower prices because of lower expectations for volatility. That is an important element of the way that options are traded. So I don't disagree with the commenter. Anyway, but we can also see this on a broader scale. So I'm not going to be making any changes to today's NVIDIA position, although do you think some traders might be tempted, especially, let's go back to our chart. Now it looks like our stock is bouncing off support. It may be starting to push toward resistance again. We'll see. But for right now, we have an obligation where somebody can buy our shares from us for $195 if they want to. We can remove that obligation if we were to go successfully close out this call we might be able to close it out for a fraction of what we were originally paid to get into it. And then we've removed that upside cap. So I think there are pros and cons to that. I think what we're going to do here is let this continue to work, but recognizing we still have that cap in place. All right. Mark says you'd have expected a significant fall in the value of these premiums after earnings. Yeah, very commonly you'll get right here. There's kind of an example here. There's an earnings announcement. Typically, there's a ramping up of volatility expectations leading into an earnings, and then a drop right afterward, known as the volatility crush, because it crushes the premiums on options. It crushes the value of those options somewhat. What it does is it reduces the time value of those options, and it can be significant in some cases. It can be comparatively insignificant in other cases. There wasn't as much of a volatility crush here. Volatility started to retreat, but now sometimes you'll see a pretty strong collapse right afterward. Ravindra says, Cam, would you use Bollinger Bands to sell covered calls when a stock is touching a higher band? I can relate to that logic very quickly, Ravindra. I can't ever say whether a trader should or should not, or what I do. I never get into what I do. The problem with discussing my approach to the management of my portfolio is that it sounds like, ooh, this is a good way to do it, and everybody listening should do it that way themselves. That's outside the role of myself. It's outside my role as an educator to tell anybody how to manage their portfolio. I'm not an advisor. I carry the licenses of an advisor, but that's not my professional role. All right. Eva, are you experiencing buffering? Dragon Rider says sound keeps breaking up. Well, we'll just hope that stabilizes. I'll keep an eye on that. Anyway. Okay, so let's look at things from a broader perspective here. Let's plan and place a new trade, but I want to look at this volatility on a wider scale. So let's go have a look first of all, what's going on with stocks. I'm going to take off the implied volatility here. We're going to replace that with something else on the index scale. But this is the point I wanted to make. As I was going through our current positions, so many of those, for so many stock investors and traders, we're seeing stocks pretty much going sideways. And if you look at the S&P 500, you look at where we are right now, you go back to October 27th, there's been almost zero net change. Some down, some up, but overall, if a 401k is feeling kind of sluggish, that's because stock performance has been sluggish, going back now more than 4 months. And that's even, it even stretches back even further if we're in, let's say, NASDAQ securities. Let's look at the NASDAQ composite. That, if you look at where we are right now, take this all the way back, not to the end of October, but to the end of September. Yeah, it's been 5 months and change. So for those looking for capital appreciation in their stock portfolio, it's been kind of a slog. But for those who have been selling income along the way, that may, I can't guarantee, but it may have enhanced that performance like it has in our portfolio. So let's add to this portfolio. But I want to look at what's going on with just the general expectation of volatility for options, not just on a stock by stock basis, but overall. So let's bring up the VIX. So if you're not familiar with the VIX, it's a volatility index of the S&P 500. It's what are options traders basically expecting on the S&P as far as volatility is concerned over the next 30 days. And it rises and falls. And generally speaking, as it runs up, we'll see options prices across lots of stocks increase. As volatility expectations run down on the S&P 500, we'll see a lot of those options premiums come down. So for an income trader or investor, they might see these spikes and say, oh, wow, premiums are really juicy today or this week compared to where they have been in previous weeks or months. But here's the point I wanted to make, and that is that when volatility spikes, let me just phrase it that way. When volatility spikes, what do you think comes along with that as far as risk is concerned? There's a reason those premiums are higher, and that's because the expectation for movement, either up or down. This is actually non-directional. It doesn't tell us which way options traders might expect a movement. They may not know themselves. They're just expecting volatility. More volatility in the markets can raise the risk, at least conceptually. So the premiums being higher are basically potential compensation for taking stronger risk at the moment. We're stepping into choppier waters. So what happened with those waters today? Well, I think there was some, I think a lot of shareholders were kind of rattled by the escalating tensions in the Middle East and in Iran over the weekend. And so there was a gap upward in anticipated volatility levels as of this morning. Now we might feel kind of a general exhale happening, people feeling a little bit calmer, and we can see that calmer expectation reflected in this big red candle. Volatility expectations have dropped since just this morning. But if we were looking at premiums just a couple of hours ago and comparing those to premiums right now, what we might see is the premiums are lower right now. So for some income investors, they might actually wait for spikes in volatility and use those to sell when premiums are high. Now, I would say they need to keep their eyes wide open that sometimes volatility expectations are for very good reasons. And this can come with a spike in risk as well. All right. But thank you to the commenter who left that comment. I think it led to a valuable discussion. But let's go plan and place a new trade in our portfolio. And what I've done is I just went over here to the charts tab, opened up the S&P 500, looked through some of these largest capitalization companies for a position where we don't already have a covered call. And I noted we actually have some shares of Walmart already in the example portfolio. And if we frame, so let's see, we bought the Walmart shares at 104.25. Right now they're trading at about 128. So this has been doing fairly well. Let's bring up the Walmart chart. Now, a couple of things that someone who's looking to sell covered calls might keep an eye out for is for some, they do look at technical strength just to gauge whether they actually want to still hold on to the shares. They might have purchased the shares for fundamental reasons. But if they entered those shares for technical reasons, it looks like Walmart has been stair-stepping its way higher, running up and pulling back and running up and pulling back and running up and pulling back. Most recently, though, it looks like we've come back down to a cyclical low, starting to advance again. Let's say that we're the hypothetical owners of these 100 shares of Walmart, and we still think that the short-term outlook is good. Let me switch my drawing tool here. Let's make this case. Let's say that this investor still thinks the stock is on the rise despite a few days of selling. And maybe they think we're going to go up and challenge these recent highs again by the March expiration. I'm going to sell another covered call for March 20th. Maybe, I don't know, maybe we'll look at April. Dan, you say you love Walmart. It's been great trading options. That's fantastic. Always just remember that my discussions are never a promotion of a specific approach or a specific security. It's always just for educational purposes, but I also don't have to tell anybody, don't say what you enjoy. That's great. Anyway, let's just say that this investor wants to allow their stock some breathing room. But how about, I don't know if we're going to be able to sell all the way up at the 135 at those previous highs. Might be looking more at 131 or 132. Walmart tends to have $1 strikes that we can choose from. So let's go look at the covered calls. Oh, actually, before we do that, let's look at the implied volatility, which is the whole point of this discussion. Let me click on the little flask icon. I'm going to type in IMP for implied volatility. Add that back to our chart. Click apply. And if we look at where Walmart is right now compared to where it has been, it looks like we're kind of in the middle. There's a sort of average volatility expectations. We're not at lows where the premiums might be comparatively small, where the income expectation may be lower, but at the same time, maybe the waters That's the way I phrase it. The waters are a little bit less choppy, a little calmer times back here. But we're also not right near the most volatile levels. Mark's saying the implied volatility pretty low. I'd say it's, yeah, Mark, it's certainly lower than it was. And that was, look at this, associated with an earnings announcement. So we got more of this volatility crush right after that earnings that Mark says he might be looking for. Yep, we've seen that. But the premiums, what we need to be prepared for here is that if we were able to sell when premiums were higher previously, that might have spoiled us a little bit. Premiums might be a little bit lower. Let's go see. Let's go look at our trade tab. Walmart, let's go with the 20th of March first, okay? Or initially, I should say. What if we were to look at the 131 strike? Looks like it's trading between $1.75, $1.84, maybe $1.80. The income investor might be able to get from this one. 132, we might be able to get $1.45-ish. On a $128 stock, that might be, that's a little bit more than 1% for an 18-day obligation. If we're willing to settle for a little bit less than 1% for that 18 days, might be able to go up to 133. What do we think? Are any of these looking like it might be striking that balance between giving the stock enough upside potential, but also collecting enough premium for the trader to consider it worthwhile? Or should we go out, maybe consider going out to a more distant contract? Maybe we can look at some weeklies here. What if we look at the 2nd of April? That one's going out exactly a month. Right now it's the 2nd of March. If we look at the 2nd of April, the 132 contracts, instead of being, what was it, about $1.45, it's more like maybe about $2.15 or $2.20. Dan says, do you look at Delta? Delta can be a guide for some, Dan. Yeah, Delta gives us a couple of different important insights into the way an option behaves. Number one, it can tell us how much the stock might, or the option might rise and fall in value if the stock goes up or down $1. But it also can give us the relative likelihood of the contract expiring in the money. Or in other words, the relative likelihood in this case of being called out at expiration. So should we throw on Delta up here? Now notice when we go to weekly contracts, volume and open interest liquidity tends to be lighter. We'll typically see a bigger spread between the bid price and the ask price. That's a common compromise that a trader might be taking. All right. How about we switch this up though? Let's throw on our Greeks. So we're going to go to the column sets. Let's change this to delta, gamma, theta, and vega. And that 132 strike is around a 36 delta. In other words, another way that a covered call seller might look at this is there's about a 36% chance that the stock might go up above 132 and be above 132 at expiration, and the shares are assigned called away. That would mean we sell those shares for 132. We bought those shares for, what did we pay? It was some time ago. Bought them for 104. So that would just be the end of that trade, realized gain. Sean's saying, not very many open contracts. That's not uncommon, yep, with weeklies. Especially, little insight about these weekly contracts, the longer the time frame on the contract, those are the newer weekly options. They're the ones that were just introduced and they just started their way toward expiration. They haven't been traded for very long, and so there won't be much volume very commonly. There won't be much open interest quite commonly. So like if I go to the 10th of April and I look at that 132 strike, and if I look at the volume and open interest, I expect to see very small numbers here, even though Walmart's one of the biggest companies in the world, because these have only been trading for a few days. Okay, which one should we do? Should we go? First decision might be, should we stick with the 20th of March or go out further in time? 20th of March are the monthly contracts with narrower spreads between the bid and the ask price. It's a shorter term obligation, but smaller premiums. The longer dated options are going to have higher premiums, but they'll have wider spreads usually on these weekly contracts, and it's just a longer term obligation. What do we think? I think what we're going to do, I think I'm just going to go back to the 20th of March. Let's go here. Let's go to that 132. And let's see if we can sell this for $1.45. Okay, so I'm going to click on the bid price. We just have 100 shares of Walmart. So let's just do one contract. Click on the bid price. That brings up an order for 10 contracts. I'm just going to do one. And, I said 145. I don't know if I can get that right now. Let's put in a limit order at 140. And we're going to click confirm and send. Now, obviously, regardless of where we set our limit, there's still not a guarantee that we'll get that filled. Yeah, I know, Eva, you said you'd say leaps. Yeah, I know that. But we're going to stick with these shorter term contracts for this one. In any case, we're going to attempt to sell the 132 20th of March call for $1.40. If we get that, there is a 65-cent commission to be paid, which will reduce that minimum credit that we'll accept to 139.35. That's still over 1% potential income for just 18-day contract. Let's send that order off, and it filled at 143. All right, great. Dan says if you want to keep the shares, go higher on the strike. Yeah, Dan. Yep, you're exactly right. If the investor prefers a stronger probability that they will not get assigned, maybe sell further out of the money. If their emphasis is on premium and they don't mind assignment, or they're okay with a higher probability of assignment, maybe you go closer to at the money and get a larger premium. Good, very good. All right, but we are done with that. We're going to follow up on this in future webcasts, but I need to move this up now. It should be part of our covered calls and short puts discussion. So let me right click on that. We're going to move that to our covered calls and short puts group. And there it is. Okay. Mary Burns says, what was the delay on the Walmart? I don't know, Mary, not sure what you mean by the delay. Let's see if there are any other questions. I think that brings us up to speed with the questions. So guys, we've accomplished what we set out to do today. I wanted this discussion to be about why options premiums are sometimes comparatively juicier than at other times, and what the trader and the investor need to be aware of. Higher premiums come from greater volatility, which should equate to, in the trader's mind, an awareness of the potential for greater risk. So it's a sort of a greater risk, greater reward trade-off scenario there. So hopefully this has been an interesting discussion for you. We'll follow up on this trade and the rest of them in future weeks. And this is what we do on Mondays. So if this is your first time, welcome. It's great to have you watching. I hope you put it in your personal calendar to either join us in a live stream or just keep an eye on the future webcast archives as we post those to the playlists. But we've done what we set out to do today. We want to talk about volatility. We want to look at our current positions, current market conditions, plan and place a new trade. Got it all done. So I'm going to let you go enjoy the rest of your day and the rest of our webcasts. But as you do, remember, first of all, if you haven't subscribed to our Trader Talks channel yet, do that now on YouTube. You just go down below the video and click on the subscribe button right now. It only takes a second. It doesn't cost anything to give us a subscription. But our Trader Talks channel is where you can join our live streams, like this one that I'm hosting right now. Or if you can't do that, you can also find the playlists right here. So if I click on playlists, for this webcast series, we have a whole bunch of playlists. You can scroll on down toward the bottom, about 3 rows up from the bottom. So just scroll down to the bottom, work your way up, and there it is, covered calls and short puts. You can click on view full playlist, and you can see our discussion from last week, which was deciding whether to keep selling covered calls when a stock is struggling. Now, another thing that Barb and I would suggest you do is to follow us on social media. We get the question all the time, how do we contact our coaches? How do we connect with them? The only way to connect with us when the camera's not on is through social media. So you can follow Barb and me on X. You can find Barb there at Barb Armstrong CS. You can find me on X at Cameron May CS, but we're both very active here. I just posted this morning. I wanted my followers' input on as the S&P has been pulling back, coming down to those 2026 lows again. Is this support level going to hold? Does it seem more likely that we go back up to the 7,000 level? Or if support breaks, maybe we pull down to that 6,550 level. So that'll be interesting. But if you reply to my comments here, or if you reply to my posts, I just try to reply right back to you, and that allows for that ongoing interaction when we're not having a live stream. All right, but you can also follow me on LinkedIn now. Go to linkedin.com/in and then throw on /Cameron May CS. So that's my profile on LinkedIn. You can just give me a follow there, and you can see I post here as well. And if you comment here, I try to reply right back to you. So everybody, Mark says, how do you know this isn't the AI version of Cameron? Well, check out number of fingers, and you can also see that Charles Schwab up here is spelled correctly, right? Anyway, thanks for joining me today. I'll see you in a future webcast. Thank you for all of the thumbs up that I've seen. 124 people watching the live stream right now, and I can see 51 have already clicked the like button. That's always appreciated. That's received as applause to your presenter, so thank you. But it also gives my webcasts a boost in the YouTube algorithm after the fact. It just helps more people find these, what I think are important discussions. All right. Everybody, thanks. I will look for you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.